So the percentage of receivables method, um, instead of using like credit sales or total sales as the basis of the estimate, which doesn't really make sense because like for credit sales, even if you use credit sales where there is an account receivable collected, maybe you collected most of that in the same period, right? Maybe it was like a 10-day kind of payback period. Your typical customer pays you back in 10 days. So a lot of those credit sales you've already collected in the period. What the percentage of receivables method is doing instead is looking at the end of the period, what is your actual balance of accounts receivable, right? Forget about how the revenues and the sales and all that, but how much account receivable do you actually have as of the end of the period? And then based on that, what percentage of that are you going to estimate is going to go bad? Okay, so this is called a balance sheet method because, again, you're not looking at your sales or anything. You're looking at just the hard number of what is your outstanding account receivable at the end of the period. Okay, it doesn't matter if the account receivable is from uh, 60 days ago or account receivable from 1 day ago. You're going to just look at what is the outstanding account receivable balance and then apply a percentage to that. Okay, so that seems a little more reasonable because, again, a lot of the credit sales that you generated in a period, you've probably already collected. So it seems more reasonable to me to just look at the end of the period, what are your account receivable balance? Okay, some percentage of that is going to be uncollectible. Okay, so we're going to basically, again, the percentage that you come up with, that is a whole kind of topic in itself, where that percentage comes from. But what we're going to basically do is, instead of just taking a percentage of the sales and like using that as the bad debt expense, you're going to figure out what the target balance should be for your bad debt expense account. So you're basically like, okay, I have a certain amount of account receivable at the end of the period. I'm going to say 5% of that is uncollectible based on my estimates. So I want my piggy bank to be 5%, right? I know exactly how much I want in my piggy bank, right? Instead of calculating the amount of the adjusting entry, I'm first starting with how much my piggy bank should be, right? So this is different than what we just did, because again, in the last method, we just took a percentage, multiplied it by the amount of credit sales, and this was the amount of the adjusting entry, right? It doesn't matter what net balance that's going to give to me for allowance for bad debt. This is just the amount I'm going to take as the adjusting entry for bad debt expense. Now what I'm doing is I'm saying no. Like, see, in this case, we just calculated this. This was kind of a byproduct of both this adjusting entry and all the stuff that happened in the past, right? Now what we're doing is we're going to start by saying what this should be and then backing into this adjusting entry amount. Okay, so it's a fundamental difference. Okay, so again, we're going to start with figuring out what this target balance should be. And this is going to be your ending AR balance times some percent estimate. Okay, so again, we start with the target balance. We see what happened in the past, what our unadjusted balance is, and then we're going to figure out what this amount should be. Okay, so it's starting from a different place, right? We're starting with the target balance and we're backing into how much the adjustment should be. Okay, so in my opinion, this is a better way because you really just care about how much should be in that piggy bank, right? That's a more common sense approach, in my opinion. Okay, and you're also gonna get rid of structural misestimates because you can see in this case we had 800 in our piggy bank. We actually had 900. So we didn't have enough in our piggy bank from the last period. We were off on our estimate by $100. We underestimated. Now, since we're starting with this, in this adjusting entry, we're going to get to this balance plus make up for this mistake, right? So in this adjusting entry for this period, we're going to correct the sins of the past, essentially. Okay? Or if we let's say instead of this being 900, this had been 500. Okay, this would have been $300. In this case, we overestimated. We had a piggy bank of 800, but actually we only took $500 of losses. In this case, we're going to benefit from that by taking a smaller adjusting entry here. Okay, we won't have to take as much out as an expense because we kind of are benefiting from this existing balance in our piggy bank. So again, I think this idea of figuring out what this ending balance should be and then figuring out based on that how much to adjust for, that makes more sense in this case of allowance for bad debt, in my opinion.